Hello guys, has the bubble popped off the stock market? Is the top in, or are we gonna continue to go higher? That's what I'm gonna discuss in this video, because a lot of people have been calling for the top here in the stock market, and I've been calling for higher prices. And I see some very interesting technicals right now that we need to cover here to discuss how low we can go and if we're ever gonna get to this median line. So you that follow me, you know I have been having this monthly chart since 1975. We've had this pitchfork here, and we are calling for the World War III to start and for the big drop here. Basically, we're gonna pop the bubble once we reach this median line here at around 6,000-7,000 of the stock market. In my opinion, I still think we have higher to go, and I will explain why in a second. So the Elliott wave, I've had this as a 1, 2, 3, 4, and then we finished the smaller time frame fifth wave here. And then we had a small recession here in 2022. We had basically the stock market was going down since the end of 2021 down in 2022. We had basically just a year where we're going down. So that was the outcome after the fifth wave. And right now we have on the bigger time frame, we have another 1, 2, 3, 4. This is super cycle Elliott wave count. And right now we're expecting for the fifth wave to finish. I see a lot of people are already talking about that this might be the top, and we're now going to start a massive recession here to the downside. But in my opinion, I still think we're going to go higher, because in my opinion, this median line has to be reached before we can really continue the way down. And because at the end of the day, this median line is controlled by the big algorithms. When I say algorithms, they are the ones that buy and sell. I'm actually not a big fan myself of technical analysis in general. So the very few tools I use to try and predict price. One of these tools are these pitchforks here, because over and over again, they do predict bottoms and tops. In my experience, when price has been inside a pitchfork for so long, it will be very unlikely for price to never reach this median line. I'll be very unlikely, in my opinion, for the stock market to go down here without the algorithms exiting, getting their target here, selling, and that's when we're gonna get the crash. So all I look at is where is the supply and where's the demand, and I still think we'll have higher prices to go here on the S&P. Something else I want to cover is, though, that I do believe has caused this pullback here is the Nasdaq. So as we covered in the previous video, we can see here when we talked about that the Nasdaq has hit the median line here. We can see here how this median line here respected price perfectly. So once Nasdaq reaches smaller time frame pitchfork, this is a smaller one, so it just goes back to 2020, but it lined out perfectly here on the Nasdaq. So I do think that this is just algorithm selling, and of course this is affecting all markets. You can see here how precise these median lines here. That's why I'm using them. So they're super precise here, and they do like to predict tops. But overall, I still think the Nasdaq has higher to go, since on the S&P this pitchfork is much more substantial than this smaller time frame we have here on the Nasdaq. So on the Nasdaq, this one is just goes back to the COVID lows here. But if we check on the S&P, this one goes all the way back to 1974, and I just don't see how the market can crash here without the algorithms realizing their gains. And I still do believe the Fed will step in. They will issue more debt just to keep this market higher. I still believe most people don't understand the level of corruption of this market. This is not a free market anymore. This is a managed market, and I do still think we're gonna go much higher. But first I want to show you one pattern here that I found very interesting. So for you that guys know, I'm not really a technical trader, even though the looks of it is from my videos. I don't really like technical analysis. I think most technical analysis is a lot of garbage. But I, over the years, have developed my own strategy where I just try to find, to see patterns in the market, which I do believe are used by algorithms. One of these patterns are these Fibonacci levels. So the only two Fibonacci levels I use is 0.31 and the minus 0.236. And I will explain to you why. So in short, basically the rule is from the second wave, you pull the Fib tool up to the third wave, and usually the fourth wave likes to bottom at the 0.31, as we can see here. So if we take here from the second wave back in 2003 to the recent highs, we had in 2021, sorry, and then here we can see where the stock market bottomed at the 0.31. That's where the algorithm stepped in, and look where we now have stalled. We have stalled at the minus 0.236. So this is a very typical level where the algorithms like to sell. So that's also a reason I do think this could be a major top in the stock market. So we could see a substantial pullback here, but I still believe even though we have a pullback, this is very typical price action when we get in a blow of top. So we can get these very steep pullbacks before then we'll continue very rapidly higher. This is usually what happens at the end of bubbles. We could see this also if we go back here in Bitcoin. We had the huge bubble in 2018. We could see these rapid drops before then we had the blow off top. So I do expect something similar to happen in the stock market as well. And we can see the exact same pattern here played out in the COVID crash. So that's why I'm talking to people that it's all about supply and demand. There's no real news actually controlling this market. It's mostly the algorithms. I know I will get a lot of backlash for this, but I'll explain to you exactly why. So we can still use the same second wave here, but if we pull the fib here back to the high we had here in, let me just see. Let me just remove this. So the high we had here back in 2018 before the COVID crash. For those who remember, this is the crash we had during the coronavirus. So if we come here on the weekly chart just to make this seem better. So we can see here where that once again 1 2, and this was back there or fourth wave. So the 1 2 3 4, and then the fifth wave was the one that came just before Corona. So we can remember here the huge rally we had once we had the crash down here in 2018 during Trump. We can see here how the stock market rallied really rapidly straight into the minus 0.236. And right when the algorithms hit it, just 1 week later, the Corona news came. And I think it was when the Corona hit America. And we can see the major correction we had here. And I don't think people understand how significant this is. So we can just, to make this more clear, I think most people don't understand how significant this pattern is. Because most people are like, okay, the stock market crashed because it was Corona. In my opinion, I do believe it was crashed because the algorithms got out of the market. They got in at the minus, at the 0.31 Fibonacci, where the fourth wave bottomed, and they exit at the minus 0.236. So that's why, in my opinion, these are the only fibs I use. And right now we're seeing kind of the same pattern playing out on the S&P. We just still use the same second wave here, but we just continue to go higher. So we basically continue to use the highs here, the next highs we made. So with the macro super cycle, third wave, fourth wave, and right now it looks like we are in some kind of correction here. I'm still not sure to call this the final fifth wave, because we could see something like this in the stock market before then we'll continue higher to reach the median line at around 6,000-7,000, and that's what's going to cause the World War III. And I'm guessing sometimes early or mid 2025 we're going to reach this median line. So that's why I'm still skeptic to start selling here or even shorting. In my opinion, I do believe the smart things you can do is come here on the weekly time frame and look for any pullback to the 0.31. So if we pull here from the lows, these lows here to the highs, we're approaching the 0.31 here at around 5,194. This would be an area of interest to me here in the stock market. There's a lot of fear also right now in the stock market. I see a lot of people calling for the tops. I do think we're very rapidly going to get a substantial bounce to the upside. So it's just a matter of time, in my opinion, before the Fed steps in and just continues to pump the stock market up, because the run has not finished yet. Even though we're getting these multiple sell signals also on the Nasdaq here, this is normal price action in blow off tops. So you get these impulsive moves to the upside before they will continue higher. We can also see here on the 10-year yield, the 10-year yield dropped like crazy in the past few days. We're down like almost 10% in just 1 week of the 10-year yield. And usually this is a very bullish sign of the stock market. So when the 10-year yield is spiking, that's usually when there's a lot of risk. When it's going lower, that's a bullish sign. We can also see same here on the dollar. So if we check, the dollar index has actually been following our plan that we discussed on our crypto channel. So the dollar has just hit support here at 103. We can see this is a similar analysis. I'm using the pitchfork here. I'm using the shift one in this example. We came down here on the dollar. So a weak dollar is also bullish usually for the stock market. There's also possibility right now that the dollar could continue lower. We still have the modified shift here, which is slightly lower at 102. But I do believe here at 103, which was our main target. So the dollar could start bouncing here. But overall, the dollar is dropping. The 10-year yield is down. I just don't see how the top would be in for the S&P. I still believe we have higher to go. This is the main pitchfork that we've been having here for years. We've been calling it since last year that this is going to be the most impulsive move to the upside, and I still stand by that. So time will tell right now. We can still add some extra lines here to the pitchfork, like to add the minus 382 and then minus 25 and 0.25. We can see right now the stock market has stalled at the 0.25 here. Let's see on the weekly. You can see found some kind of support here. I'm not sure if it's going to hold. These lines are not always strong support resistance. They're more like guidance lines going to show where price might find support. But in my opinion, the stock market from current levels has at least another 33% to go before we see any major top, and that's when we're going to start shorting it, and probably that's when we're going to start the multi-year bear market, in my opinion. So that's all for me for today. I hope you enjoy my analysis, and as I said, I'm still bullish. You want to long this market. Most people don't understand the corruption of this market, how leveraged this is. There are still banks holding a ton of leverage, betting on the upside of the market. I just don't see how they would let this stock market go lower or start a recession, because I see a lot of recession callers here. The recession is not going to start yet. Once you reach this median line, that's when the time to short everything, get out of everything, and just basically go into risk off assets, risk on assets. So otherwise, thanks so much for watching. Please like the video if you enjoy these type of videos, and see you again, guys, in the next update.